Good afternoon, and welcome to our Social Security Planning webinar. My name is Pigeon. I am the Chief Operating Officer of Hobbs Group Advisors. We are a financial planning and wealth management firm in Columbia, South Carolina. We provide investment management services, retirement planning consulting, and financial planning to our clients, to individuals, to businesses, and to certain not-for-profit organizations. So, and today I'm going to spend about 30 minutes talking about Social Security basic rules and claiming strategies for 2022. This will be one of several webinars that we will be having this year, where our goal is to do one per month. And perhaps we can drill down into more Social Security specific strategies in the future. But today, this is meant to be about kind of the basics and a couple of things to think about as it relates to Social Security planning. So sharing my screen, and we'll move on to the first slide. So the most important thing, and this is kind of laid out with rules, several rules, but first rule being your monthly benefits will rise with your claiming age, right? In other words, the longer you wait to file for Social Security, the higher your benefit will be, right? Kind of logical. The sooner you take Social Security, the less your benefits will be. How will this affect your plans? So with that, we can add a little background. So the first thing to point out, in our world, we use all these acronyms. Social Security is no different. There's alphabet soup. So a couple key terms. One is your primary insurance amount. That is your PIA. That's the acronym we will use. That is your base monthly benefit. Okay, so when we say PIA, that's your Social Security benefit, depending on the age in which you take Social Security. This is calculated at age 62. It's based on your highest 35 years of earnings. You'll receive this amount if you apply for Social Security at your FRA, which stands for full retirement age. And as an example, the maximum benefit, or PIA, for someone born in 1960 will be $3,357 per month. Okay, now that is available to them when they reach their full retirement age. So it's not available to them at age 62, but it's calculated at 62, which is super confusing if you think about it. But that's the theme. There's lots of confusing items as it relates to Social Security. It seems like it could be simple, but it is not, which is why we're having this webinar and why we talk to our clients about filing for Social Security before they actually do something. So as we get to full retirement age, this gives you an idea. Everybody's full retirement age is based on their year of birth. So the easy part is if you were born 1960 or later, then your full retirement age is age 67. So that's easy. People born before 1960, that's where there's some variances based on the year in which you were born. And you can see it's either 66 or something in between 66 and 67 if you were born from 1954 to 1959. So if you're in that range and thinking about applying for Social Security, this gives you an idea of when you will reach your full retirement age, which is an important age for several reasons. Obviously, it's important because it's the age in which you will receive your full Social Security benefit without any reductions. We'll talk about what those reductions could mean. And basically what that does mean is if you file before this age, before this date, or before that certain age, then your benefit will be lower. And that is called an actuarial reduction. And on the flip side of that, claiming after that age, for every month that you wait, there will be an increase to your benefit. And this is called a delayed retirement credit. So the idea of drawing your Social Security prior to your full retirement age, at your full retirement age, or after your full retirement age are areas where we talk to clients about the benefits and the drawbacks to doing those sorts of strategies. So, all right, well, if you do file early, what does that really mean? And if you do wait, what does that mean? So we'll start with the early part. If you file early, your benefit will be reduced. And it depends how early. And it also depends on whether your full retirement age is 66 or 67. As we look back, to that previous slide, that depends on the year in which you were born. But just in theory, you're taking a reduction of somewhere around 8% per year. It's not quite 8%, 7% per year by drawing early. So what that means is, if your full retirement age was 66, if you draw at 65, you get 93.3%, right? If you draw at 64 and so on and so forth. And the point of this is that Social Security has created these reductions so that actuarially, based on the average of life expectancies for all of the Americans that file for Social Security, the impact to Social Security is about the same. The impact to the financials of Social Security. Now, that's using the law of large numbers. That has, so that's fine as it relates to, the millions and millions of people that apply for Social Security. That does not necessarily mean that it means the same to you, right? Because everyone has different assets, different incomes, different life expectancies, different, so many different variables. So when you file for Social Security is extremely important to the individual. To Social Security, they'll say they don't care, because based on life expectancies of millions and millions of people, it's about the same, because if you draw early, you get more money sooner, but you in exchange for a lower benefit for the rest of your life. Of course, the way we view this is that our goal as advisors is to keep our clients from running out of money. So oftentimes Social Security being the benefit that you can't outlive leads us to talk about deferring Social Security when that's appropriate, if it can be done. So here are the consequences, or what we would say the benefits to waiting right after your full retirement age. We just talked about the reduction. Well, how about an increase to your benefits? And basically this equates to about an 8% annual delay credit. And it's actually calculated on a monthly basis. So it doesn't mean you have to wait a full year. If you wait 6 months, it would be 1/2 of 8%. So it would be 4% benefit. So every month that you wait, it's basically 1/12 of 8% that your benefit increases by that percentage. So here's, for someone who has a full retirement age of 66, waiting until 70, and age 70 is the maximum. You cannot wait any longer than 70. So if you wait to 70, you have to start drawing your Social Security. I say that I had one client who didn't even start until after 70, but that was on them. And but theoretically, you cannot wait any longer. You will not receive any more benefit for waiting past 70. So start drawing it at that point in time. But that's 132% of their benefit. For those that have a full retirement age of 67, now you're waiting 3 years instead of 4. So the increase is not as large. It's still 124% of your benefit. So 8% per year, significant. We think it's significant. Also, to add on to that, Social Security has something called a cost of living adjustment. It happens for people that are receiving Social Security, and it happens for people who are waiting for their Social Security. So what that means is your benefit for Social Security, even if we project what that might be 5 years from now, more than likely will be larger, because what we don't know is what these cost of living adjustments will be. And inflation is kind of a big theme this year. So in 2022, the cost of living adjustment for Social Security benefits for everyone that was receiving Social Security benefits was 5.9%. If we continue to have this inflationary pressure that we've had, this adjustment for 2023 could also be large. Now, that being said, in years where we don't have much inflation, right, sometimes you see benefits not increasing at all. Over the last 75 years, the average increase is 2.4%. But it does mean that there is an inflation hedge to your Social Security benefit, which is nice. Because as we know, things get more expensive in the future. So your Social Security income is meant to increase so that you can continue to have the same purchasing power. Doesn't always work out that way, but that's the idea. But if you take into account the delayed credits that I just mentioned, plus cost of living increases, it can be a much larger benefit for waiting to receive your Social Security. So key points to remember in this: if you apply early, your benefits start lower and they stay lower for the rest of your life. It is permanent. Cost of living adjustments do magnify the impact of early or delayed claiming. The longer you live, the more beneficial it is to delay your benefits. I think that's logical, right? Obviously, we don't always know what our life expectancy will be. That being said, my experience, and I think some of the studies that take place, is that most people underestimate their life expectancy. Most people we talk to say, "Oh, I'm not going to live past 85," and oftentimes they do. So we're not always the best judges of our life expectancy. There's some resources for that. Obviously, your health, family history, things like that do play a role. But once again, our job as financial planners is to keep our clients from running out of money, right? So our idea of Social Security being that benefit that you cannot outlive is very attractive. And oftentimes we're talking about that in conjunction with your other resources. Decisions that impact survivor benefits. For example, these decisions will impact for married spouses. That's a big deal, right? Delaying your benefits could impact a spouse if you predecease your spouse. We'll talk about a little bit of that in the coming slides. But when we're talking about Social Security for spouses, it's not just about this spouse and that spouse. It's about the two of them together, because together, who's going to live? How long will the last spouse be alive, and how will these decisions about drawing or not drawing your Social Security impact both of you? That is a big deal. And obviously, as I just said, lots of factors that are personal, that are individual, that would come into play here about when to draw your Social Security. And we're going to expand on that. So a couple of things on estimating your Social Security benefits. Really good resource for doing that is going on to socialsecurity.gov /my account. Everyone has access to this website. Your annual Social Security statements are there. If you're talking to a financial professional, I suggest getting the most recent one of these and taking that with you when you're having a consultation about Social Security planning. That's super helpful. The other thing is that even if you're younger and you're not drawing Social Security yet, that will give you an idea of what that benefit might look like. And if it tracks your annual earnings. So as your annual, as your career progresses and as your earnings perhaps increase or change, you can see how that impacts your benefit. So that's a good resource. We do suggest everyone to have at least, not that you need to do it every year, but certainly as you get closer to thinking about retirement planning, and especially if you're talking about retirement planning, this is a good resource to gain that information. So basic rule number 2, as we move on, your spouse may be able to claim benefits based on your earnings record. Well, what does that mean? And is that a smart thing to do, and how is it done? So I just kind of talked about the Social Security website. If you get your Social Security report, it basically points out that, and most of the time it gives you 3 metrics. If you're under the age of 62, it'll give you a metric that says at 62, which is the earliest you can receive benefits, your benefit will be X. At your full retirement age, depending on the year you were born, whether it's 66 or 67, your benefit will be a larger number. And then if you wait till 70, that number will be the third number. Those are the first 3 things that you typically see on your Social Security statement. And then you also see some information about what your earnings history is. And the IRS provides that information to the Social Security Administration to track your earnings and verify your credits that you receive. So as we talk about spouses, every married spouse is entitled to 50% of the worker's primary insurance amount if the spouse applies for at full retirement age. So what that means is this: married couples have some choices, and a lot of this was designed to protect non-working spouses. Okay, and the other thing, when we talk about people drawing off of other people's record, the number one thing to point out is that it doesn't impact the person who's applying for benefits. It doesn't impact the amount they receive. Right, Social Security just takes your benefit into account when they're looking at how much could your spouse receive in this situation. Yours isn't affected. But if a primary worker, in this case, applies for benefits, and did so at their full retirement age, that 66 or 67 or somewhere in between, then a spouse can also receive benefits. Now, there's a calculation for this. If that spouse is also full retirement age, the easy calculation is that the spouse could receive 50% of whatever the primary worker receives. And we have some examples we can talk about in just a second. There are no delayed credits for spousal benefits. So if a spouse is going to draw off of another spouse's record, it doesn't benefit them to wait past their full retirement age to start receiving benefits. That is important. It can benefit the primary earning spouse to wait, and we'll have some case studies to talk about that too. But for the most part, you can only receive spousal benefits if it's greater than your own. Okay, so kind of logically here, if you've worked and your benefits larger than the 50% of your spouse's, then obviously you would not want to take your spouse's. But there are some times where that number is close, and there's some planning opportunities with looking at those two numbers, and you have a choice in that situation. So, how do you calculate the spousal benefit? 50% of the primary workers, primary insurance amount, PIA. If started at full retirement, here's an example of Jack. Jack, his primary insurance amount is $2,000. Jill's, from her earnings history, was $800. So if Jill applies at her full retirement age, assuming that Jack has already done so, her benefit, which is her spousal benefit of 50% of Jack's, is $1,000. So she'd rather take the $1,000 than the $800 in most cases. So that's an example of spousal benefit. So here's another. But what if the spouse's own benefit is higher? Okay, well, we'll look at Jack and Jill again. So if Jack's is $2,000, if Jill's benefit from her earnings is $1,500, she would rather take the $1,500 from her own than draw one half of Jack's, which is $1,000. So that is typically how that math works. There are a couple of exceptions. Okay, and this exception is really only applicable for people that were born before 1953. So this is kind of already gone. But prior to some changes that took place with these calculations, if the spouse was over 62 at the end of 2015, that spouse may file what's called a restricted application, which was almost like a little bit of a loophole, which basically said that the spouse could receive the spousal benefit and let theirs continue to grow. So in other words, if the spouse could receive the 50% of the primary spouse's benefit, but then let their benefit from their work history continue to build and then continue to grow with those deferred retirement credits we talked about. And then at age 70, sometimes their benefit would be larger than the 50% that they were receiving from their spouse, and they could switch. But that was a strategy that is no longer available for anyone who was younger than 62 at the end of 2015. So that's basically most people that are probably listening to this webinar. So, we often talk about maximizing benefits between spouses for Social Security, because there are far more variables, far more flexibility when you're talking about husband-wife than if you're talking about an individual. Because for one individual, much easier, right? You're only dealing with one life expectancy. Now we're dealing with two life expectancies, and for spouses' ability to share benefits, this becomes a little more complicated. And I think that, requires a little bit more planning. So, how do you maximize benefits in this particular situation where a lower earning spouse's primary insurance amount is more than 50% of the higher earnings primary insurance amount? Do we let both spouses could delay to age 70, or a strategy could be one spouse takes advantage of spousal benefits, right, and the other one waits, and that could be a way to maximize lifetime benefits over long life expectancies. So we'll kind of dig into this. But here's an example number one. This is Bob and Betty. So Bob, let's see here, Bob, and we use a calculator to run these scenarios. But in this scenario, they both claim as soon as possible at age 62. That's scenario one. In scenario two, we'll show you how they both apply at full retirement age. And then scenario three, one claims early, one waits. And scenario four is the maximum benefit based on life expectancies. And we have to assume a life expectancy. So in this case, here are our variables. Bob and Betty are 60. Bob's primary insurance amount is $3,000 per month. Betty's primary insurance amount is $1,800 per month. And we anticipate that Bob will live to age 85 and that Betty will live to age 95. We typically assume that a female will live longer than a male. The statistics do show that, as do the fact that we have more widow clients, female widow clients, than we do have widower clients as males. So lots of thoughts to that, but now a 10-year difference might be kind of large, but who knows about Bob's family history and Bob's medical history and things of that nature. But in this case, we're going to assume that there's going to be a 10-year period where Betty's going to be alive and Bob is not, and that's a long time, right? So here's our scenarios. Scenario one, they both take as early as possible. Many people in this country draw their Social Security benefits as early as possible. We believe that many people in this country that do that leave a ton of money on the table. And here's why. They receive at age 62. Bob's getting $2,200. Betty's getting $1,345. At age 85, Betty can, and we didn't talk about this in the previous slide, but a spouse can choose, once one spouse passes away, the surviving spouse can choose to take the higher of the two benefits. So in this case, Betty can now start drawing Bob's benefit, and Bob's benefit has been increasing every year through cost of living adjustments, right? So, which is the inflationary hedge. So that's why at age 85, that benefit's $3,535. Betty can start drawing that for the rest of her life. And the total amount of benefits that they collectively received over their lifetime was $1.7 million. Okay. Scenario two, what if they both wait to age 67? Okay, so you see the numbers there. Since Bob waits longer, Betty can then start drawing $5,000 per month, which is his benefit that is now starts higher and continues to grow with cost of living adjustments. That's $2.1 million. And then in scenario three, this is one where Betty draws early. On her record, Bob waits until 70. This protects Betty because now when Bob passes away, Betty's income turns to $6,225 because she gets to take his benefit, which was started even larger because he now waited to 70 and it grew with those cost of living adjustments. Total benefit over their lifetime is $2.247 million. And then the fourth scenario, which is the maximum lifetime scenario, is that both of them wait till 70. Of course, we don't always know that someone's going to live to age 85 and 95. So, the difference between option 3 and 4 is not huge. But if you look at the difference between options 3 and 2, 3, and 1, that's a big, big number. And since we don't know life expectancies, one spouse waiting usually makes sense to protect, especially if there's an age difference between spouses, or especially if there's a health difference between spouses. Those are things that protecting the remaining spouse is a big part of Social Security planning. That's a big part of what we do when we're talking to our clients about it. But you see the difference over a lifetime between a couple. Here's a scenario, or this is just some charts and graphs that shows you the total benefits in kind of a graph format. And then you kind of see the cumulative benefit comparison. So, and there typically is a break-even scenario in most of these, and you can kind of see it somewhere around, 2040, 2039, somewhere around there. The idea is that if you start receiving benefits, earlier, then there is a point in time where it benefits you to wait. Obviously, when you get into your 80s, you win by waiting every time. But there is a scientific approach to this. We have calculators that can kind of show the benefit of waiting, and why that often is a decent idea for at least one spouse. And once again, first year income for surviving spouse, I mean, look at the annual income number for Betty. If Bob predeceases Betty, right? We're assuming he dies at 85 and she's going to live another 10 years, or longer. I'm not sure exactly. I think we're assuming they're the same age, so another 10 years. So, I mean, look at her income by the scenarios where there's some form of waiting. It's a big difference in income. And that could mean, a lot to what Betty's standard of living will be, right, when she's a widow. So here's a second example. This is so Bob and Betty, they're 60 now. Bob's primary insurance amounts $3,000. Betty's is $800. So we changed her metric a little bit. And we assume they have the same life expectancies. How does this look? So here are these same scenarios again, but the total amounts are a bit lower because Betty's primary insurance amount is lower. I think in this case, we're going to add a few different scenarios, because there's what's called a spousal add-on, which means she can start drawing the spousal benefit at a certain time. So for example, let's see here, if she waits 5 more years to claim it full retirement, so nominal benefits are slightly lower than the first scenario, but you still see the difference in benefit here. Spousal add-on would be the 1/2 of the full retirement age benefit, and you see the chart in the graph here. So, and that just points out that every scenario is different for every client. We try to map this out to help our clients make an informed decision. The rule number 3, somebody who's divorced may have access to draw off of an ex-spouse's benefit. Once again, doesn't impact the ex-spouse. They still get their same benefit, but in certain cases, a divorced spouse can qualify for benefits from their divorced spouse. So couple rules to this: the marriage has to last for at least 10 years. The person receiving a divorced spouse benefit has to be unmarried, and the ex-spouse has to be at least 62 years old for someone else to draw off their benefit. So slightly different rules than for a married couple. And I think if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So a couple notes on this. If a person has multiple ex-wives or ex-spouses, not to pick on men, but as long as the marriage has lasted for at least 10 years, there's no limit. I've not encountered that in my career, but it's theoretically possible. Benefits paid to one ex-spouse do not impact those paid to the worker, those paid to other spouses, or their current spouse if they're remarried. Once again, this doesn't impact anyone else's benefit other than the person who's applying. Even if they're applying off somebody else's earnings record, you will need a divorce decree, typically when talking to Social Security, to prove that there was a marriage that happened. And if a divorced spouse remarries, the spouse who's receiving the benefits on another person remarries, then they would stop in this scenario. And so in rule number 4, there are quite, and I talked about this a little bit in section 2, but there are significant benefits to widows and widowers. What we call survivor benefits. There are even certain benefits to children, and certain benefits to surviving spouses. And I have seen this and used this for clients throughout my career. In this case, a couple must be married for at least 9 months, and except in the case of an accident. And survivors must be at least 60 years old to start receiving survivor benefits. Okay, that benefit is reduced if you, it's almost like drawing your Social Security at 62. There is a reduction. There are some exceptions for someone who is disabled, but at full retirement age, a surviving spouse can receive a full benefit. And for surviving spouses, this is interesting. The benefit is not available if the surviving spouse, if the widow or widower remarries before the age of 60. After the age of 60, the surviving spouse can remarry and they can still receive survivor benefits. Or I guess unless that marriage ends, so I guess if they get married before 60 and then they get a divorce, they then are eligible to receive survivor benefits from the previous marriage. That's confusing, but that is a big deal. Survivor benefits can be very, very important for a surviving spouse. There's no doubt about that. And then a divorced spouse survivor benefit available if the marriage lasted at least 10 years. So in other words, if that's going back to the previous slide, married for at least 10 years, ex-spouse passes away, you can also receive survivor benefits as long as your marriage lasted 10 years. And you still have to be at least 60 years old to receive that benefit. So those are rules for surviving spouses. There are some abilities, and I talked about that kind of ability to choose between records in a previous slide, but for a surviving spouse, widow or widower may switch to a higher benefit if their benefit grows. The example of that is Joe and Julie. Joe's benefit is $2,000. Julie's benefit is $1,200. Joe passes away. Julie, who's been drawing $1,200 a month on her record, notifies Social Security, and she can now start drawing his, right, the $2,000. And then the caveat, obviously, if Joe waited to take a Social Security, the amount Julie would have gotten would be higher, and that's going back to the Bob and Betty case studies that we just talked about. Survivor benefit. They do depend on a couple things. The age at which the deceased spouse originally claimed his or her benefits. That's why we say the person drawn at 62 who passes away prematurely and had a higher benefit than their spouse is going to leave less money to their spouse or less income to their spouse than the person who waits. The way we deal with this is by perhaps waiting to draw benefits for the higher earning spouse. And also deals with the age in which the widower claims the survivor benefit. Drawing at age 60 for a survivor is going to be a reduced benefit versus waiting until their full retirement age, which is 66 or 67. So that's that same calculation and reduction of benefits. The way you maximize this is by having the widow or widower wait to claim that, perhaps, if they can. This, sometimes people can't wait, and that's understandable. But if they can, or if they think about, we talk to clients about what if you could use another asset, right, to replace your Social Security income. That's something conceptually people have a hard time thinking about. But if you can have a higher benefit later, why don't you use perhaps some retirement money or some other savings or something along those lines to allow your Social Security benefit to wait? That's a strategy we talk to people about all the time. So strategies for widows and widowers, you could theoretically start with one benefit and switch to the other. If you are a surviving spouse, you always want to take the higher benefit last, right? So if the survivor benefit is higher, you may want to take your own benefit at 62, which is reduced, and you know that you could switch to the survivor benefit at full retirement age. And if your retirement benefit is higher, you may wish to take the survivor benefit at age 60, which is drastically reduced. But if you were the higher earner, then you could wait to 70 and all of a sudden you get a drastic pay increase for the rest of your life. Lots of flexibility and strategies for widows and widowers. And the idea of this is what we call sequencing, right? So Wanda's she's age 60, her primary insurance amount is $1,200. Her deceased husband's primary insurance amount was $2,600. So in scenario one, Wanda starts drawing her own benefits at 62. which is a reduced benefit because she's drawing it at 62, right? So there's the haircut that we talk about for $840, and then she switches once she reaches her full retirement age, 66 or 67, or somewhere in between, to $2,600 because she's entitled to that because that was her deceased husband's benefit. Scenario 2 is, what if Wanda starts to receive what if she says, all right, I would prefer to do the opposite. I want to start receiving my survivor benefit at age 60, which is $1,859. Which one is better for Wanda? So here's the math. So scenario 1, she claims a survivor benefit. I'm sorry, I think this is scenario 2. That's confusing. Scenario 2, she starts drawing the 1859. So 1859. All right, so this is scenario 2, which is really confusing. And this is scenario 1, where she starts drawing her own at 62 and waits until age 66. I don't know why that's oriented that way, but it's better for Wanda to draw her own retirement at 62 and then wait to receive her deceased husband's benefit at age 66, which at age 66, she has no reduction in that benefit. And with the cost of living increases, it's now $3,000 a month. And therefore, over the rest of her life, if we assume that she lives to 95, she's going to receive way more income and be better off, to the tune of $300,000 over her lifetime. So that's pretty significant. So basic rule number 5, people who start drawing their Social Security early and they're working can sometimes be a problem. There's something called an earnings test. And basically that means that if you start drawing money before your full retirement age and you are still earning income, wages, typically earned income, that doesn't mean income from your retirement accounts or income from a passive real estate or something like that. This is wages or earned income. If you receive over $19,560, if you are below your full retirement age drawing Social Security through work, you're going to take a reduction of your benefits, $1 for every $2 you earn. So pretty significant. This is why we just tell people, don't start drawing your Social Security before your full retirement age if you're still working, right? Since the idea of Social Security is to replace your income. There may be some exceptions to this, but paying the penalty on Social Security is not a very good deal. What will happen is that once you do reach your full retirement age, that penalty goes away. But that being said, it very rarely makes sense to do this. Some people do it and they don't realize that's what they're doing. But at the same time, don't stop working either, right? If you still are enjoying working, or if you still need to work, the best way to do this is to wait, because your benefit continues to increase. So you don't pay a penalty, your benefit increases, and in some cases your Social Security benefits can be taxable, so you won't pay tax on them. So this applies to all benefits before full retirement age: your retirement benefits, spousal benefits, and survivor benefits. So a survivor who is still working perhaps needs to wait until their full retirement age to start drawing those widow or widower benefits. That may have an impact on your spouse's benefits as well, because most people who are married file a joint tax return. And self-employment, self-employed people, there is some more scrutiny associated with Social Security benefits. So those are things to think about. Basic rule number 6, taxation of your Social Security. This is almost 100% dependent on your income, your other income that you receive on top of Social Security. For people who receive Social Security and have no other income, you do not pay tax on your Social Security benefits. But for the people that we work with, they typically have some other form of income, right? So the calculation is what's called provisional income. You see how this calculation works. It's confusing. It takes your adjusted gross income, which is basically the part of your tax return before you look at all of your deductions, plus 1/2 of your Social Security benefit, plus tax-exempt interest. You add those things together and they exceed $44,000 for a married filing joint couple, then you're going to pay up to 85% on your Social Security, the tax on your Social Security. So if your provisional income is under $32,000, which basically means if you only receive Social Security benefits, nothing else, you pay no tax on your Social Security. And then that $12,000 difference, or kind of what we call phase out range, then all of a sudden your Social Security becomes up to 50% taxable. And then over $44,000, your Social Security benefit will be up to 85% taxable. That doesn't mean you pay 85% tax on it. It means that 85% of that number shows up on your tax return, and you pay your appropriate tax based on your tax rate and then your deductions and all those things. So whenever we talk about tax, it always gets very complicated because everyone's situation is very different. For many clients who have other income, if you have a pension, state retirement, income from your IRAs, you will pay tax on your Social Security more than likely. Question is how much. And one of the things that we talk about from a planning standpoint is you just need to know that you will pay tax on it, so you don't have a surprise, that first year that you start drawing benefits, which happens from time to time if people did not think their Social Security benefits were taxable. The good news is for high earning people, 15% of it's not taxable. So I guess that's your good news. I think that's something that could possibly change in the future if we talk about viability of Social Security, but it's a conversation for another webinar. How do we minimize taxes on our Social Security benefits? You can, like, if you're still working, you could reduce your income by putting money into tax advantage accounts like retirement accounts, things like that, which could help you for a little while. You need to think about the money you have to start taking out of your IRA accounts. Right now, that age is 72, you're forced to take some money out of your retirement accounts. So think about what that is. There's some ways to think about using that that's not taxable as well. We do a lot of work with Roth conversions. So for example, for people that are waiting, we do a lot of planning well before Social Security, where we have people set aside some funds perhaps that they could use to replace their income from when they retire to the time they start. If they're waiting to draw their Social Security at 70, they retire at 66. Those are what we call the gap years. And we really start talking about doing Roth conversions pretty aggressively. Very complicated, requires a lot of planning, but that's something you could do in those years that you're waiting to draw your Social Security benefits. And obviously delaying your Social Security will just reduce the years you're subject to tax. And I don't know how much of a benefit that is because you also don't get income during those years. Reducing your expenses, that's always a good strategy. But thinking about your taxes in retirement, your taxes do not stop once you retire. I think that's important to point out that there does need to be, some dialogue and some thoughts surrounding that. So that is the end of our webinar. We appreciate you being with us. Like I said, we will continue to hold these on topics that we think are important for our clients and our participants in retirement plans that we work with. So we invite you to keep a lookout for the next invitation. If you have any specific questions to this or your specific situation, feel free to email us. We're happy to answer questions, and give you our thoughts. And we certainly appreciate you listening and being on the call. Thanks.